Welcome to our channel. Today we are going to explore how to account for a trade-in with a loan payable in QuickBooks. Let's dive into a real-world example to make it easy to understand. Sarah, who is trading in her old vehicle for a new one. The dealer gives her a trade-in allowance of $10,000. Here are the details. Purchase price of the new vehicle, $40,000. Trade-in allowance, $10,000. So the loan amount will be $30,000. The difference between the new vehicle and the trade-in allowance. Okay, and then to account for this transaction, we will make the following journal entry. First, we will need to remove the old vehicle and accumulated depreciation and the loan balance. So accumulated depreciation, suppose it's $5,000. The vehicle amount was $30,000. The vehicle cost here need to be removed from the box, so it's credit, as you can see, and then we'll have to debit the loan balance because we're removing it, which is $25,000, and then we'll need to record the new transaction which is the new vehicle, $40,000. It's an asset and we'll have to debit it, so it's $40,000. Record the liability of the loan payable, $30,000, and record the trade-in allowance, $10,000. In this example, the trade-in allowance of $10,000 reduces the cost of the new vehicle, resulting in a lower loan amount of $30,000. By following these steps, you will be able to accurately account for the trade-ins with loan payables. Thank you for watching, and don't forget to subscribe for more accounting content. Thank you.